We're going to cross over now to Singapore and speak to Clive McDonnell, Head of Emerging Markets Equity Strategy at Standard Chartered Bank. Clive, welcome back to the program. Good to see you. It's been a while. What do you think of Operation Twist? When you say less dramatic, what kind of impact are we talking about?
Well, I think that the effect on Asian equity markets is very limited in itself. However, I think more important is the move in exchange rates that we've seen over the past week or so, which reflects a increasing preference amongst investors for liquid assets. Liquid assets, low risk, and that all things point to Treasuries in that sort of an environment.
Okay, what does that mean for equities? Because it seems that we saw the slamming on Wall Street. So financials, of course, having their own problems, dragging the index down. But it seemed like the only ones that benefited from this announcement were those bondholders.
Yeah, for sure. In the U.S. context, it's U.S. Treasuries. We saw the 30-year note, slip quite dramatically, by about 20 basis points, about 15 maybe for the 10-year note. But looking specifically at Asia, if we think about the evolution of the current bear market, it hit very much the North Asian countries first. They dramatically underperformed their Asean counterparts. But now with the collapse we've seen in exchange rates, that's particularly noticeable in ASEAN. The Singapore dollar is skirting with 130 today. I think we're starting to see now a reassessment of the outlook for some of the ASEAN markets, and particularly because of their lack of liquidity. And as I mentioned at the outset, investors are putting a big premium on liquidity at the moment, and as that, or by that, I mean specifically U.S. dollars or U.S. Treasuries.
Yeah, let's talk about some currency moves we saw this morning. Was it any surprise to you that we hit parity with the Australian dollar and the Kiwi getting slammed, but that's because economic growth disappointing the markets as well?
I think it doesn't come as a surprise. I think we'll see more Aussie dollar weakness because it basically corrects the paradox that we saw during the first half of September, whereby the Aussie dollar was quite resilient and the US dollar via the DXY was also quite strong. And both those send conflicting messages. A strong DXY or strong dollar signals trouble in the global economies. People have a preference for the greenback. But a strong Aussie dollar signals that the global economy is doing quite well. It reflects overall commodity demand. So both those being strong were incompatible. And our view was that given the preference for investors for liquidity and risk-free assets, it was the DXY or the dollar that would win out. And eventually we'd see the Aussie dollar correct. And we've seen it go from 105 to, as you say, parity this morning.
Yeah, that's quite interesting, quite a dramatic move as well. So you prefer ASEAN and India over North Asia. Why India? That surprised me. I understand ASEAN since it's quite a favorite of a lot of investors because of the domestic market that they have. But India, we have a lot of problems in this economy as well. Inflation, high, big concern. We could see more tightening taking place. And the stock market has really underperformed this year.
Yeah, the stock market has certainly struggled under the dual weight of the ongoing political crisis, which is driven by the corruption scandals, and also, of course, the 12 rate increases by the RBI so far in this cycle. But our view is that a lot of the bad news is increasing in the price. India entered this downturn a lot earlier than many other of the economies. And quite specifically, the RBI face a very, very tough choice going forward, whether or not to go for growth and sacrifice inflation, or to continue to try and target inflation and sacrifice growth in the process. Our view has always been that Asian policymakers go for growth over inflation. And with the huge surge in the labour force that's forecast in the coming years, we think that inflation will have to remain high in India, but that we will see trend growth rise there going forward.
Okay, and what about China? Because, yesterday we heard from Jim Chanos again, the bearish hedge fund manager in China, saying he's shorting Chinese banks and property. Why do you prefer India and ASEAN over China right now?
Well, the problems facing China are much more structural compared to India. India is going through a bout of cyclical anxiety, but in China the problems are structural, particularly in the banking sector. As we know, a lot of anxiety surrounding the local government project financing and the extent to which banks are adequately or not adequately provisioned for that. Banks are a huge sector of the market there, 34%, and there's no sign of any resolution on that. The earliest that we'll likely see something is by end of this year. Banks are supposed to move 25% of their local government loans towards normal loans. And whether or not we see a significant pickup in provisioning as a result of that, that might bring some clarity to the situation. But at the moment, there's no indication of any improvement in the problems facing the banks, and the news in the property sector continues to get worse.
All right, Clive, thanks for joining us today. Hope to see you more in the future. Clive McDonnell of Standard Chartered Bank joining us from Singapore.